Hello everyone! Welcome back to your channel Realm_Reach, the place where we explore the world of finance and investing. Today, we're going to delve into a topic that's absolutely crucial for anyone looking to navigate the stock market, particularly in India. We're going to discuss the key fundamental parameters that you need to consider when selecting stocks. These parameters provide a solid foundation for making informed investment decisions. They are like the building blocks that help you evaluate a company's health and potential for growth. They're like your compass in the often complex and volatile world of investing. By understanding these parameters, you're equipping yourself with the tools you need to make better, more informed decisions about where to invest your hard-earned money. So, without further ado, let's dive right in. Understanding these fundamentals is like having a compass in the complex world of investing, so let's dive right in. Before we jump into the parameters, let's quickly discuss why fundamental analysis is so important. Think of it as a doctor examining a patient. Just as a doctor can't diagnose a patient's health based solely on how they look on the outside, you can't gauge a company's health solely based on its stock price. This is where fundamental analysis comes in. It peels back the layers of a company, allowing you to examine its financial health, competitive position, and growth prospects. It's like taking a company's pulse, measuring its heartbeat and checking its reflexes. It takes into account everything from a company's earnings and revenue to its debt levels and market position. In essence, it's a comprehensive checkup of a company's financial health. So why does it matter? Because it's the bedrock of informed investing. By analyzing a company's fundamentals, you're essentially evaluating its health and potential for growth. The first parameter on our list is earnings per share, or EPS. This is the amount of profit that gets attributed to each outstanding share of a company's common stock. It's calculated by subtracting dividends on preferred stock from net income and dividing by the average outstanding shares. So, if a company is consistently showing a rise in its EPS, it's a good sign. It means the company is growing its profits. But remember, it's not just about the figure itself. The consistency and rate of growth matter too. Moving on, we have the price-to-earnings ratio, also known as the PE ratio. This is a valuation ratio, calculated by dividing the market value per share by the earnings per share. The PE ratio tells us what the market is willing to pay today for a stock based on its past or future earnings. A high PE ratio could mean the stock's price is high relative to earnings and possibly overvalued. Conversely, a low PE might indicate that the current stock price is low relative to earnings. But remember, this ratio should be compared with others in the same industry. Next, let's talk about the debt-to-equity ratio. This ratio is particularly important because it gives us an idea of a company's financial leverage. It's calculated by dividing a company's total liabilities by its shareholder equity. Essentially, it shows the proportion of equity and debt a company is using to finance its assets. If the ratio is high, it means the company has been aggressive in financing its growth with debt. On the other hand, a low ratio generally means that the company has not been aggressive in relying on borrowing to finance its growth. Diving further, we come to the dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. The dividend yield is calculated by dividing the annual dividend payment by the stock's current market price. If you're an investor who likes to see a return on your investment through regular income, a high dividend yield is something you might look for. Next in line is the return on equity, or ROE. This is a measure of financial performance and is calculated by dividing net income by shareholders' equity. Essentially, ROE shows how well a company uses investment funds to generate earnings growth. Companies with high ROE tend to be more efficient in generating profits and growth. Last but certainly not least, we have market capitalization, or market cap. This is the total market value of a company's outstanding shares of stock. It's calculated by multiplying a company's shares outstanding by the current market price of one share. Companies are often divided into three main sizes based on their market cap: small cap, mid cap, and large cap. Each of these sizes come with their own set of risks and returns. Small-cap companies might offer more growth potential, but with higher risk, while large-cap companies may offer more stability, but with slower growth. Different-sized companies, small-cap, mid-cap, and large-cap, have distinct risk and return profiles. So when you're selecting stocks, it's important to consider these key parameters. They provide a clear picture of a company's financial health and its future growth potential. Remember, smart investing isn't just about following the crowd. It's about understanding the fundamentals and making informed decisions. So equip yourself with knowledge and step confidently into the world of investing. As we wrap up, remember that investing in stocks requires a solid foundation. This foundation is built on understanding key fundamental parameters like earnings per share, price-to-earnings ratio, debt-to-equity ratio, dividend yield, return on equity, and market capitalization. By closely examining these parameters, you're setting yourself up for a more informed, strategic approach to investment. It's like having a compass in the complex world of investing. But remember, this is just the beginning. The world of finance is ever-changing, influenced by market trends, economic conditions, and global events. It's important to stay updated, continuously learning and adapting along the way. And don't shy away from seeking advice from financial experts. They can provide valuable insights, helping you navigate through the investing journey. So arm yourself with knowledge, stay informed, and tread wisely. Always conduct thorough research, stay updated on market trends, and consider seeking advice from financial experts.